Hi, good day everyone. With me again, Dedi Trialdi in Introductory Macroeconomics class. In this video, I would like to continue the discussion about the monetary system. After I explained about the nature of money and the money creation process, another thing that needs to be elaborated is about how the central bank controls the money supply. We know that with the big influence of commercial banks in the money creation process, controlling money supply is not easy for the central bank. Basically, there are two ways how the central bank controls the money supply. They relate to the money creation formula here. In this simple formula, two elements appear, namely R or the total reserves, and this fraction, the money multiplier. The central bank's control of the money supply, therefore, is indirect. It uses monetary tools that influence the quantity of reserves and thus that influence the reserve ratio and in turn the money multiplier. The central bank changes the quantity of reserves either by buying or selling bonds in open market operations or by making loans to banks or by some combination of the two. Let's check the first option. But before we proceed, again recall that money supply is assumed just equal the total deposits. There is no currency in circulation. Deposits, as we understood from the money creation discussion, grow bigger than its initial amount whenever loans can be made. Okay, suppose now the central bank purchases $50 worth of government bonds. Before the purchase, the overall balance sheet of the commercial bank is as shown in the first account here. Money supply is $1,000 equal to total deposits of commercial banks in the monetary system. With 10% reserve requirement ratio, reserves are $100 and loans are $900. After the purchase, more dollars now are available in the monetary system. If the $50 are held as currency, money supply increases by $50 too. But since we assume that there is no currency or all the $50 are deposited in banks, money supply increases a lot bigger than just $50. Look, if the central bank purchases bonds using reserves instead of using currency, commercial banks' reserves in total increases by $50. Total reserves are now $150. Which commercial banks get the increased reserve? Before the loans are made, of course, those banks where the government banks are located. Then, with 10% reserve requirement ratio, the additional $50 of reserve causes deposits to increase by $50 initially. But with more and more loans created or with money multipliers, deposits increased by $500 instead, or 10 times the additional reserve. From the balance sheet, we can find that the increased amount of total deposits are because of the $400 additional loans that have been made in the monetary system. So here is the complete look of the annuity account of the overall balance sheet of the commercial banks. It should be clear right now the impact of open market operations, in this case through the purchase of government bonds by the central bank, is an increase in the money supply. From buying $50 government bonds, money supply increases by $500 or equals the increase of total deposits. The opposite will occur for sure if the central bank sell bonds instead. Money supply will decrease as a consequence. The second option to increase the quantity of reserves, as I mentioned earlier, is by making loans to banks. The central bank uses discount rate as a tool to do so, raising the discount rate to restrict commercial banks to borrow and lowering it to attract the commercial banks to borrow. Suppose the central bank reduces the discount rate, causing the loans to commercial banks to rise by $20. Before the purchase, the overall balance sheet of the commercial bank is again shown in the first account here. Money supply is $1,000 equal to total deposits of commercial banks in the monetary system. With 10% reserve requirement ratio, reserves are $100 and loans are $900. And with the same assumption that currency is omitted from the monetary system, the loans to commercial banks raise the commercial bank's reserves by $20 as shown in the second account here. Total reserves are now $120, but because of the loans commercial banks owe to the central bank, the $20 of commercial bank's debt are added as new liability. Now, what will happen to the commercial bank's deposits and loans? Well, it's just the same as before. Using the money creation formula, the $20 of the additional reserve create more loans and cause the deposit to rise by $200 or 10 times the additional reserve. From the balance sheet, we can also observe that the rise in deposit is due to the $200 additional loans that have been made in the monetary system. So, total deposits are now $1,200. Money supply is again equal to total deposits. After the discount rate is reduced, money supply equals $1,200 or increases by $200. Okay, let's turn our attention now to the monetary tools used by the central bank in controlling the money supply that influence the money multiplier. The first option is through adjusting the reserve requirement ratio. Remember the definition of the ratio here. It should be clear that the higher the ratio, the less excess reserve the commercial banks have that can be converted into loans, implying the lower money multiplier and the lower money supply. How does the process look in the overall balance sheet of the commercial banks? Using the same T account here, this is the initial condition. Money supply is $1,000. When the reserve ratio is raised from 10% to 20%, we can observe from the new T account, total loans that can be made from the $100 of reserves are now lower. Using the money creation formula again, the maximum total deposits are just $500, half the amount of the previous deposits or $500 less. And from the balance sheet, it means that only $400 of loans available in the monetary system, also $500 less from the initial amount. From the process, we can observe that raising the reserve ratio from 10% to 20% could effectively reduce the money supply from $1,000 to $500. If the reserve ratio is set lower, the opposite for sure will occur. The money supply will be higher because more loans can be made with the more availability of the excess reserve. Money multiplier can also be induced indirectly by adjusting the interest rate paid to commercial banks that hold reserve at the central bank. In the past, holding reserve at the central bank got no interest, but recently, the interest is given and it becomes another monetary tool the central bank can use to control money supply. The impact of the increased interest payment on reserve is quite similar with that of the increased reserve ratio. You know, when the interest on reserve is set higher, commercial banks may choose to hold more excess reserve and restrict themselves in making loans. The same is true when banks are restricted to make loans because they are obliged to do so by the reserve requirement rule. Therefore, the change in T account and quantity of money supply are similar. Look, this is the impact of change in reserve ratio in my previous explanation. With the $100 of reserve, deposits are totaling $500 because the reserve ratio has increased from 10 to 20%. When the interest of reserve is instead increased, while the reserve ratio is still the same at 10%, what is happening is that the banks choose not to loan out all their excess reserve. So out of $100 of the reserve, if half is the required reserve and another half is the excess reserve, then using the money creation formula, the maximum deposits are not 10 times $100, but instead 10 times $50 because the $50 of excess reserves are not loaned out. So as I said at the end, the impact of changing the interest payment on reserve is quite similar to that of changing the reserve ratio. Money multiplier is affected and in turn causes money supply in this case to fall by $500. Having understood the monetary tools used by the central bank in controlling money supply as well as how the tools could effectively affect the quantity of money supply, we realized that controlling money supply is not easy. We know already that the central banks can only affect the money supply indirectly. Other than that problem, the central bank is also facing the unpredictability of depositors' behavior. Look at the first T account. It is an example of the depositor's balance sheet. Worth noting, of course, that deposits are in assets, not in liabilities for the depositors. For banks, deposits are in liabilities because those are the amount of money they owe to depositors. In our previous discussion, we assumed that there is no currency outstanding. In fact, all of us hold cash amid the development of e-money that complements debit and credit cards. In reality, Individuals also have financial investment options other than depositing their money in the bank. They may buy stocks and bonds or fixed assets like property. Both conditions, to some extent, might reduce the central bank's control on money supply. Cash holding and securities holding may induce the banking system reserve. When people tend to hold more currency, for instance because they lose confidence to banking system, money supply falls even without any action from the central bank. Similar to individuals, banks' behavior could also be unpredictable. Some banks may be holding more reserve than the other for precautionary reasons. Moreover, making loans are not the only option for the banks to generate income. They could buy more securities in financial markets instead of loaning out their entire excess reserve. Or, just like individuals and households, banks could restrict themselves in making loans due to bad economic and financial condition. Those unpredictabilities of depositors and banks may be negligible or correctly anticipated by central bank during normal condition. But during crisis or unexpected economic conditions, awareness and careful calculation may be more than required. Okay, that's all about the monetary system at the moment. Central banks and commercial banks obviously play key roles in money creation process. The capacity and the willingness of commercial banks to provide loans are critical to the process, and those at the end depend on the central bank regulation and each bank policy. Thank you for your attention. See you again in other videos with different basic macroeconomics topics.